All right, I've had numerous requests regarding how I got 2 free ski houses, and so today I want to go into a little bit more detail on how exactly I achieve this. Now, hopefully I cover everything that you all have been looking for, but if I don't, feel free to hit me up directly, either by reaching out to me via my website, mglunk.com, or if you look in the show notes, I'll have links to my contact information where you can reach out to me directly and or schedule a meeting to connect with me. And so the concept of how I achieve this is pretty common. Actually, it's something that people use in different ways, but I'll talk to you about specifically how I did it, buying land and then building on it. And so for some background, I bought some land in Grand County, Colorado. I then subdivided it. There's a couple different triplexes around my property. I wanted to do something different, and so I wanted to build some single family homes. But also in a way that I felt would be good to achieve my goals. And so I built a smaller home that I currently long-term rent. And then I also built a larger home that I short-term rent. And I built it in a way that allows flexibility. And so this home is a 6-bedroom, 4.5-bath, and it sleeps 15 people. At the time when I built it, there weren't many properties of that size to rent out in the area, and so it's been a great short-term rental. There have been some more properties that have come onto market in and around that size, and so the competition has definitely been increasing. I also subdivided the lot so that the smaller home was on its own single-family lot. However, the larger home, it actually has enough square footage that that lot is zoned as a duplex. And so I have the option of converting the property into 2 different units if I wanted to. Now, I haven't done that yet because I like to use the property during the shoulder seasons for my family, but if I wanted to increase the revenue, that would be something that I would do there as well, where I would divide it into 2 units. And so I set the property up in a way that made it easy to do this by allowing the stairwell to be locked off, and I also pre-plumbed the lower level for a kitchenette. But that's not why you guys are watching this, right? You want to know, how did I get these properties for free? And the concept is simple. I've got some notes here that I'll definitely reference because I want to make sure that I don't miss any points, but I want to make sure that I'm covering off on some of the key concepts with regards to this approach. Now, essentially what I did was I created an instant equity gap, and this is a term that I use to describe this process. Essentially what you're doing is you're trying to build a property for less than it could sell for in that market. And so when I looked at the marketplace in Grand County, where I built this property in Colorado, and I looked at what it would cost to have a general contractor come and build my project, it was pretty pricey. It was pretty expensive, right? And oftentimes it was at or above what I could resell that property for. Not to mention the fact that when I looked at the timelines, a lot of these contractors were 2 to 3 years out. And I didn't want to wait that long to start building my project out. And so I looked into alternative options, and I discovered modular properties, modular building. For those of you not familiar with modular building, modular is not a mobile home. Modular is not a manufactured home. It is a stick-built home, just like a stick-built home would occur on your property if you had somebody come and build it on site. It's just built someplace else. There's pros and cons to both, but some of the pros to building modular is speed, so it can be done faster. It can be done typically at a higher quality because instead of building it with 2x4s, for example, it's built with 2x6s oftentimes and other stronger materials because it has to be transported from wherever it's built to the site where it's going to finally be built out into the home and or multifamily property that you're building. And so what I did was I used a company in Minnesota. So it's built in a warehouse, it's in a controlled environment. You don't have weather impacting the building process, so it's faster. The materials don't become, destroyed or affected by weather. And so that allows things to be done quicker, which is extremely important, especially when you think about where I was building in the mountains, because the build window is smaller than other areas of the country because summer is shorter and there's only so much time that you have to get things done. And so I was able to build modular for a lower cost per square foot to again create this instant equity gap so that when I was done building the project, I had my total cost all in was significantly lower than my price that I could sell the property for. And so what I did was I built the properties with a construction loan. And then when the construction process was done, I then rolled that into traditional financing, in my case, a 30-year mortgage. Now, we'll just take the larger property as an example to talk about some of the numbers. And so by the time I was done building, that property appraised for $1 million. My mortgage on that property was in the fives. It was right around $570,000. And so as you can see, I had almost 50% equity in the property. And a lot of the funds for this, by the way, because you had to fund the construction loan, came out of pocket. So I had to put some money down on the construction loan, but obviously then the bank financed the rest of it. So I did have money into the project initially. But then when I went to refinance the property, traditionally, right, there are some nuances here, but generally speaking, when a bank is going to finance an investment property, they'll typically finance 75% of the value of the property, which means you need to bring the other 25%. You need to have that 25% down. Now that can happen in a lot of different ways. If you just buy a property that's on the market, for example, you can just bring in the 25% down, the bank will finance the other 75%, and off you go. But because I was able to create this instant equity gap, when the house appraised, and it appraised for that $1 million, well, I then had a significant equity gap there, which then allowed me to get the financing where the bank not only provided the financing for the property via a 30-year mortgage, but they also gave me money back. So I was able to get all of my money back, essentially getting the house for free. And this happened with both properties. And that's essentially how I was able to make this happen. Now, lending requirements and lending terms kind of change over time. So you definitely want to talk to a lender and find one that will facilitate this, because not everyone will. And these things are kind of constantly changing over time. The interesting thing about this too is this is not a unique technique, okay? This is common, that happens in investing all the time. Something, for example, called the BRRRR follows this exact same process. Now, if you're not familiar with what a BRRRR is, I've got another video on my website that goes into more detail on the BRRRR process. But essentially, BRRRR stands for buy, rehab, rent, refinance, and repeat. Now, I've done this as well too with some properties in the Midwest where I've bought properties for cash, although you can also finance them as well. I've then fixed them up, I've renovated them. Oftentimes, I'll buy these small multifamilies, I'll fix them up, and I'll split off the utilities so that tenants are paying each of their individual's utilities, so I can put as much cost back onto them so that they're paying for the consumption that they use within their unit. And then I'll rent them out. And then I'll take that to a bank and say, here's this property, I've fixed it up, I've added value to it, I've increased the value of the property. Oh, and by the way, it's bringing in X amount of rent, which then I can clearly show that the rent will more than cover the mortgage, and then they'll finance a property for me. Oftentimes, I've been able to pull all of my money back out because I've been able to show the property after my renovations, and also through increasing the rents, that it's of a higher value than when I purchased it, meaning that when it's appraised, I then can show that I have at least, 25+% equity in the property, causing the bank to be comfortable financing the rest of the property for me. Now, this hasn't happened with every single property that I've BRRRR'd, and some people get hung up on this. They're like, oh, well, if I can't finance all my money back out, then I don't want to do it. But it still is a win, even if, for example, you can finance the majority or most of your money out, or even half of that money back out. I mean, the reality is, if anything less than 25% is a win. And oftentimes, too, through going through this process, it's a great educational process, as well as it also allows you to learn more about the property and also get it dialed in the way that you want. Because for me in particular, I also like to make sure that my properties are updated in a way that will cause me less problems down the line, right? So I'll oftentimes invest in my properties. I'll do things that maybe don't have to be done, but in my opinion should be done, because they'll cause me less headache down the line. That water heater is less likely to die. If I have an old one, I'll just replace it and make sure that I'm setting myself up for success in the future. So again, this is a general process for how to create this, whether you're building from scratch or if you're buying a current properties, you have to create that instant equity gap. And so the concept in general is pretty straightforward and simple and easy. What isn't always as easy is finding a property where this will work, right? And so it depends on the market. As you know, we have different market cycles, and this current market cycle that we're in as the filming of this video, it's a little bit more difficult to make the numbers work on a property, which first and foremost is the top reason why it's important to find a property where you can add value, because if you do that, you can then make the numbers work on the property. But the reality is, during certain market cycles, it's easier to achieve this than others. But you're watching this because you're a real estate investor, you're willing to put in the extra work. And yes, it does take some extra work and effort, but it's not rocket science. And it's something that anybody and everybody can do. So what's an example? So I talked to you about a building example. What would be a good BRRRR example? Well, I'll take one that I've done myself. I purchased a property in the Midwest. It was a triplex, and I purchased it for $70,000. I then came in and split off the electrical, because that was one of the things that was not metered across the various units. Metered meaning the fact that each unit was not on its own separate electrical meter. So I did that so again that the tenant could be responsible for their own electrical consumption, and I wasn't responsible for it. I also fixed up the units, cleaned them up a bit cosmetically so that I could maximize the rent potentials. I then had my property manager get new tenants into the property. We were able to increase rents. And then I took that package to a lender. In this case, I took it to a local lender, because the thing is, sometimes when you BRRRR, banks will not always refinance a property right away. Oftentimes they'll want to wait between 6 months to a year before they will refinance the property, right? They want it to season a bit. And more so nowadays, banks tend to be skewing more towards the 1 year mark. And so I bring it to a local bank because not only do they understand that market, but oftentimes, not always, but oftentimes these smaller local banks and or credit unions, some of these banks offer something called portfolio lending. Now, portfolio lending is where they hold the mortgage in-house, oftentimes funded by an investor group that they have. So this means, as an example, that they're not having to deal with various guidelines, for example, those imposed by Fannie Mae and Freddie Mac. Because they're holding the loan in-house, they create their own guidelines and can create some more flexibility and have a little bit more flexibility in how they analyze deals. And because they know the local market, they're then able to make a more informed decision. All right, so that's pretty much the approach. Pretty straightforward, I know, pretty clean and simple when you think about it. Again, it's not rocket science. What does take some work and effort is finding the deals, running the numbers, and making sure the deal makes sense, right? So whether you're doing a new build or you're buying something and rehabbing it and looking to pull your money back out, for example, like in a BRRRR, a lot of the work comes in simply just trying to find that and then execute on it. Okay, but the concept itself is pretty straightforward. And this concept itself, in my opinion, is something that you should be doing on every property that you buy. Now, I say that, but with a caveat. Look, if you are in a full-time job that you love, own your own business, working a W-2 job, and you're wanting to focus on that and just take the excess income that you have and invest it, then by all means, there's nothing wrong with that approach. Go buy a property. It can be turnkey, rent it out, and enjoy the long-term benefits and wealth building aspects of owning real estate. But if you're looking to try to really be involved in real estate investing, if you want to, build your wealth quickly, then a quick way to do that is by finding these opportunities to create that equity gap in the deals that you're purchasing. And this is a great approach in a market like today where it's harder to find deals, but also in a market like a couple years ago. Regardless, you constantly want to try to find opportunities where you can add value, because that instant equity will help to expedite you in you achieving your goals and reaching your financial freedom goals, because you can always use that equity for other things, right? You can use it by selling the property and taking that equity out for something else and or for another purchase. You can use it to help provide that cushion if market dynamics change. So there's a lot of benefits to having that equity gap beyond just the initial idea of increasing your net worth. All right, that's it for today. If you have more questions just like this, then definitely hit me up in the comments below. I'd actually love to know if you like this format of me just kind of talking through, I've got some notes here discussing how I think about things and how I approach certain aspects of real estate investing. So if you like this approach, then definitely let me know in the comments. And if there's certain topics that you want me to discuss, then definitely let me know those as well in the comments below. All right, that's it for today. We'll see you next time. Thanks so much. Take care.